Hi, my name is Cyndi Thomason, and today we're going to be talking about how to set up a cash buffer for your e-commerce business. Now, I want to tell you a little bit about me. I founded a bookkeeping firm in the United States called Bookskeep, and we focus on serving e-commerce sellers and providing them financial data, their financial reports on a monthly basis. After working with our e-commerce clients for 5 or 6 years, we realized that they were having challenges with cash flow. And a system that I've used in my business for this time has been called Profit First. So we took this Profit First methodology and adapted it to e-commerce businesses. And as a result, I wrote a book about a year and a half ago called Profit First for Ecommerce Sellers. And it's all about how to know your numbers and how to pay attention to cash in your business. Today, what we're going to be talking about specifically is cash flow planning in your business. So our agenda is to start with the very beginning. What do we need from our personal lifestyle to what are the cash needs to be able to fund our personal lifestyle? We all got in business for the reason of wanting to have a business that supported ourselves. And so our businesses should be doing that. But what does it really cost to take care of our lifestyle? So we're going to talk about that. I also recommend that every business and everyone on a personal basis have a cash buffer. So understanding what your cash buffer is really important. And we're going to talk about how to understand that and how much you need in that buffer. And the main part of our conversation today is going to be about 13-week cash flow planning, why it's important, and what you're going to learn from it. And then at the end of the conversation, I'm going to be doing a demo on a spreadsheet tool that we use for doing cash flow planning. And I will make that spreadsheet available to you at the end. You can download it. So don't worry about trying to copy pictures or whatever. I'm going to send it to you if you're interested in it. All right, so let's get started. Let's talk about our personal lifestyle and what kind of cash we need for that. The simple way to figure this out is simply to go through and add up what your personal expenses are. You can look back at your bank accounts, your credit cards, just get a total of what your personal expenses are. And then once you've added that up, you're able to see that this is the income that you're going to need to be able to be comfortable. Now, I know as business owners, we like to think of what our life might be like 5 years down the road, 10 years down the road, when our business gets big and is doing very well. But this exercise, we're just looking at what you need to be comfortable. I don't want you to think about having to fund an extravagant lifestyle right now. We're just looking at what you need to pay your bills, so to speak. And then we're going to reverse engineer from that information. We're going to reverse engineer to figure out how much you actually have to sell to be able to cover those personal costs. Now, we've got a calculator, and I'm going to share this with you as well. This calculator is going to take just a couple of pieces of information from you. One is that number that you just figured out. This is the number I need to be comfortable. It's going to take that information, and it's also going to plug in the information you have from your business about what your gross margin is on your products. And by plugging in these couple of pieces of information, we have backed out the total amount of sales you need to have to be able to fund your lifestyle with those couple of parameters. So again, I'll provide this to you at the end. You'll be able to download it, but it's just a simple calculator based on this Profit First method that says, you know, once you pay yourself, once you pay whatever your tax rates are, once you understand what your gross margins are, those pieces of information are baked in there. You provide a few pieces of data and it'll tell you, okay, you have to sell this much to have a healthy business and fund the lifestyle that you have. So this is what we call our owner pay calculator, and I will provide you that at the end. Oops, I went backwards. Okay, so the next thing I want to talk about is a cash buffer. Basically, you need to know at any point in time how much cash you have available in your business. It's and how long that's going to last. So you can look at your bank account and see a balance, but how long is that actually going to last you? And this 13-week planning that we're going to do, that will give you an idea of how long your buffer is going to last. You also need to understand how long it's going to support the business, but also, as we were talking, how long is it going to support your lifestyle? So if you've got a cash crunch coming, it's going to impact your business, but it's also likely going to impact your personal lifestyle and how much you're going to pay yourself. So by having a plan that allows us to see out into the future, we can understand how long this buffer is going to be available to us to help us take care of the business and also take care of our lifestyle. So let's dive into cash flow forecasting. It's the main thing I want to cover with you today. First of all, we're going to talk about what it is. First of all, it is looking at our past data and allowing you to use that to plan for your future business income and business expenses. So we're looking at history and taking that information to look and project going forward. It's also, the plan that we use is a rolling 13-week plan, which is basically a calendar quarter. It's a short enough time period that we can predict things pretty reliably, but it's also long enough that it gives us a time horizon to do something about an issue if we see it coming up. So we'll create it for the initial 13 weeks, and then you'll maintain it going forward. And every week that you add on, you'll drop one off that's kind of history at this point. You're going to add on week after week. So you constantly have 13 weeks of looking forward as to see what kind of cash situation you're going to have in that 13-week period. You're also going to start to gain awareness of when cash shortages are going to occur and how you're going to address those things so you can be proactive. It gives you that view into the future so you can plan and proactively go in there to improve the situation. All right, so why is this important? Well, first of all, you want to know how long your cash is going to last. That buffer that we were talking about, it's a bank balance is not as meaningful just to know a number. If you know a number, plus how long it's going to last, you've got some assurance of what kind of issues and decisions you're going to have to be facing in the time period coming up. So we want to know how long our cash is going to last. So 13-week cash flow planning helps us with that. It also helps us to understand our patterns of inflow and outflow. So as a business, we have money coming in and revenue, that's our inflow of cash, and we have money going out for our expenses, that's our outflow. And this planning session will allow you to look at that on a week-by-week basis and align your timing for your expenses up to when the income comes in. So to the degree that you can control that so that you level that out as much as possible, that's what we're trying to do. It'll also show you if you are consistently spending more than the income that you have coming in, and put you on notice that you need to do something to actually control your spending, because that's just not sustainable. So if you see that happening week after week, then you realize, okay, we've got to do something so that our expenses are in line with our income coming in. We also will be getting new information and updating our data on a proactive basis. This every week that you're in business, you write this story a little more. So you want to take what you've learned from this week, update your data. It helps you project and get better at projecting. And by keeping this data up to date, you're going to be proactively managing your information so that you've got the best data possible. Now, let's talk a little bit about debt. If you're in a cash flow situation where you're going to have to use debt, then you need to be thinking about debt in these three different ways. And there's two of the ways that I think are good uses for debt, and there's one way that is not the best use, and it's actually a detriment to you, probably for your business, as well as I know it's a detriment to you personally. So the first kind of debt is bridging debt. Bridging debt is when you have a situation where you know the income is there, but you just haven't received it, but you've got to make a payment, maybe for inventory, and you know within a week, maybe two, you're going to have the money in. It's just not here right now, and you need to bridge that time period. When you have that situation going on, that's called debt bridging, and that's a good use of debt in your business. The other kind of debt that's a good use is the leveraging kind of debt, where you've got a product that's somewhat proven, you've got a business model that dialed in, knowing your gross margins are really performing, and you've got your operating expenses under control, your cash flow's good, and you just are ready to grow, and you have an opportunity maybe to extend that product line in a different color or a different size or a different market. And it's a pretty much a sure thing that you're going to see some payback on that in a fairly quick terms. That's called debt leveraging. That's a good use of debt as well. The third kind of debt that's not a good use of debt is what we call delaying the inevitable. Basically, you're having to use debt to just stay afloat. You've got debt in the business, and instead of that being able to be reduced over time, you're having to get more debt in the business. When you're consistently having to rely on debt and your debt is increasing, then you're just delaying the inevitable, because the cash is not coming in a sufficient level to fund that business operations. So you've got to make some hard decisions. And in that situation, I don't recommend using debt, because it is delaying the inevitable and putting more burden for interest on your business, as well as putting you in a situation where you may have some personal liability, and that can impact your ability to borrow money in the future should you want to open up another business. So if you're in a situation where you're relying on debt just to stay afloat, you're probably better off just to go ahead and make the really tough decision to go on and get out of the business at that point in time. There's a tool that we use for helping to make this decision, and we call it the 10-10-10 tool. First of all, you just think, what is going to be the impact of using debt in my business in this way for 10 minutes, for 10 months, for 10 years? And if you can see positive results in both the short term and the long term, then probably it's a good decision to make debt work for you in your business in that way. Now, the main reason that businesses fail is that they run out of cash. So with all of these other reasons, the primary reason, I think, is we don't want to run out of cash. And in order not to run out of cash, we have to do a good job planning and managing it. So I think that's really one of the best reasons to do cash flow planning. All right, so how do we get started? First of all, I mentioned we're going to look at historical information, and that historical information is what's going to be used to help us look at the future. So you're going to need to gather up your historical information, your accounting system reports, for example, that'll tell you how frequently you get deposits in and how what expenses you're paying for week by week. Whatever you can gather out of your accounting system will be helpful. If you don't have an accounting system, go to your bank and your credit card reports. And I know credit cards aren't cash, but I'm going to show you why we use credit cards in our cash flow planning the way that we do it. And so you're going to want to have bank information and credit card information. Your statements or a download of your transactions will be what you're looking for. We're going to load that historical information into our spreadsheet, and then when we do, we'll use that to help us then ensure that we don't forget anything when we start projecting going forward. So having history there to remind us of what we pay for on a month-by-month basis will help us ensure that we record everything going forward. And that's what we're going to work on. We're going to build out the future months based on the historical information and the projection of what we think is going to happen in the future. Okay, so I want to share then the spreadsheet. This is a picture of what the spreadsheet looks like, and I'm going to go over to the spreadsheet now so that we can actually work with a live version of it. Okay. So this is the spreadsheet that we're going to be working with. So let me get you a little bit familiar with it. First of all, what you're going to see is down the left-hand side are the main categories of information we're going to be putting in. And then what we have going across the top, the columns, are the dates. So the very first thing that you're going to want to do is fill out your start date. And then once you put your start date in, I recommend starting on a Monday so that you've got it week by week. Every Monday, you'll see a date there. So put your date in of when you're going to start this, and it'll populate this information going forward on a week by week basis. Now, the weeks are going to go across till we get to 13 weeks, and then we have instructions for you on how to add additional weeks after the 13th week, because after week 1, that information is really not helpful to you anymore. But what you add on to week 14 will be what's useful, because you're looking out, and that's what makes it rolling. We're going to not worry about what already happened, but we're going to keep adding to the end so we can see things going out into the future. Okay, one other point of information about how the spreadsheet works. Anything that is in white is where you can add information. If you see it as a color, that means it's a field where there's calculations being done and you don't want to add information directly there. You're going to always add in the color block. All right, to expand this to see a little bit more information. Well, get it going here. I was not patient. So the first thing that we're going to add is our income information. So what are your top line sales? If you look out historically to what your sales have been, you can plug that data in, and then you can think about what kind of adjustments you may have to make. You may say that, all right, historically I'm at $1,000 a week, but because of COVID, I'm down 10% or 30%, or maybe because of COVID, you're up 30%. So you might put a baseline in there and then modify it with this income adjusters. And then that's where this percentage is. Again, you're going to add information where it's white or where it's gray. And then when you put that information in, it'll give you some kind of adjusted number. And if there's fees that are associated with that, like you're selling on a platform in the United States, for example, Shopify has fees of somewhere in the neighborhood of 3 to 4%. You would put that fee percentage in there because they're going to take that before you get it. So you're not actually going to see that cash. So you may as well adjust for it. And if you've got other types of fees that you know they're going to take out, like long-term storage fees or something like that, you might go on and put a percentage in. We've got places here for you to use. There's a channel fee, but then there's one that's open. You can put in for whatever you might need it for. Then when all of those information data points are put in, it will give you your total, and that will tell you the total for that particular sales channel. We've got multiple sales channels here so that you can add, I actually started at the bottom, but there's multiple lines. If you sell on Amazon, you can use that channel. Again, this over here on the left, this plus bar will expand it so you see more data. When it's expanded, if you want to shrink it so you don't see all that detail but get a total number, you can just click on it and it will actually shrink it back up so you're just seeing your total number. So all of the green here is income, and it totals up what each of those income pieces are. And it will tell you what your available cash is, because we're starting out with available cash from the beginning. And again, you don't put this number in. I'll show you where to put that in later. It's actually at the bottom of our spreadsheet as one of our starting points. But it will populate here so we know we're starting with this amount of money. We're adding to it with this income. And then we'll know how we're doing as a result of that. Now, the next series of numbers are our inventory cash requirements. I'll expand this as well. If you're ordering inventory, let's get this up a little bit. If you're ordering inventory and purchasing it where you may have to pay for a upfront deposit and then you pay for more of it later, you can record each of those types of items here. Sometimes it may be by product or SKU information. Sometimes it might be by vendor. You've got control to put in whatever you want to keep up with. Whatever order number, you may have a purchase order number that you're using to keep up with it. And then if you're paying the beginning balance, or if you're paying, the beginning deposit or the open balance at the end, the timing on that is going to, where you pay for that beginning, it may be 60 days out where you pay for the remainder of it. But you want to think about what orders have I got in place and what am I going to owe on those orders. Some of it, if you've already placed the order and made the deposit, all you're going to owe is the balance. So don't worry about putting in the deposit. But if you're projecting buying inventory and placing a new order, then you've got to consider both the deposit that you're going to make and the balance that you're going to owe, whatever your terms are. Okay, so that's your inventory component. That is all totaled up again. And at the end of each of these sections, what we do is we compare what impact that has on our cash. So the first thing is, we're adding $30,000 to our available cash because of our income. That's what this line totals up to. But then we're going to spend $12,000 of it on inventory. So that makes my cash for this particular week go down to $17,500. And then each of these blue lines, as you see them throughout the spreadsheet, is just kind of updating you on, okay, what cash is left after I do this. It's just a rolling calculation. Now, I mentioned Profit First earlier, and in Profit First, you will pay yourself. You will put money aside for a profit account and for taxes. So I like for my clients to think about that you don't just take the money that came in and spend it all. You take it and you have to set some aside for yourself. You have to set some aside for your profit. And you also have to set some aside for the government for taxes. So you go into this gray area, plug in the actual percentages that you're setting aside, and then you can go in and put each of those amounts in to actually subtract what your requirements are for that cash to be put aside for your use. So that's our Profit First piece. I'll shrink that up too. And then we get down here to the operating cash requirements. These are our operating expenses. Now there's 3 sections to this, so I want to go over each of them separately. The first thing is what will hit your bank accounts. So I like to think of these in 2 ways. There's kind of critical things that we may have deducted out of our bank account, or we may write checks for, things like rent and payroll that we want to be sure we cover every time. So I list those in the top part. And then there may be some things that are more subscription-based that are not absolutely necessary. You can list those down below. But these are things where you would write a check or have it debited out of your bank account, not pay for out of credit cards. Then I like to consider that I might not think of everything. So I put a multiplier in there, say 5%. You can change that number. But what is the degree of confidence you have that you've got everything? And if you're really confident, then you may just want 1 or 2%. But if you're afraid you're forgetting a lot of stuff, you may want 20%, 10%. So you can change that number. Then we look at our additional bank expenses, things that that you may use. Oh, okay, I've covered that already. So we've talked about additional things. So now let's get to the credit card piece. Now I want to explain how this works, because credit cards, when you actually put money, use your credit card to pay for something, you're putting an expense on your credit card. You're not actually going to be hitting your cash. You're only going to hit your cash whenever you go to pay your credit card. But I like to think about week by week how I'm obligating my money. So I would go ahead and put in to this light gray section what I'm actually using the credit cards for. But for purposes of the math of this spreadsheet, it's only going to use the payment. So I would put in, advertising expenses, maybe my payment processor, subscriptions, things like that. I would put down here below this darker gray line, just so I see it and I'm aware of it. But then the number that I'm going to put in for actually when it's going to hit my cash is when I pay the credit card, and that's up on the line with the darker gray. So that's where you want to put that information. And we've got multiple credit cards listed here. You can just expand them out so you can record that information. Now, make this work for you, not against you. You may use credit cards to buy ad spend every day, multiple times. You don't need to put in 15 rows of ad spend. Just know, okay, every week I'm spending $1,500 on ad spend. I'm going to plug that total in. So you have the discretion here to put it in as fine a level as you want, but I would encourage you not to go crazy, because if you put in tons of detail, it's just going to be hard to keep up with, and it's going to make it confusing for you. So if there's categories of things that you spend money on, like ad spend, maybe subscriptions, you can total those things up as opposed to putting each individual item in. All right, so that gets us our credit cards. And then the final section here in operating expenses is you may be paying for loans. And we've got a section here where you can put in the details about your loans. You may have multiple loans. You would just list each one and then what you're paying on that loan, because when you make those payments, that's when the cash is going to be coming out of your bank account. All right, so that gets us our three major areas of operating type expenses. Now, the next part of it, I think, is the fun part. It's what we call the what if. These are a place where you can go in and just start thinking about scenarios of things that may happen that aren't in your regular day-to-day business, but that you want to consider. So there can be scenarios like you're hiring a new employee, or maybe you're letting go an employee. What is that gonna, how's that gonna impact your business, and when are you gonna have those costs? So this is an opportunity to put that kind of information in so that you can see, can you really afford it? And if you can't, then you've got to figure out, can I do something less, or can I push this off, or maybe I just have to wait a little while till I can even consider this option. So that's the what if section. Once you get everything else finished and you get really comfortable with how the system works, and I would say after you've used it for a couple of weeks to ensure that you got it all flowing right, then the what if section gets to be the fun section. All right, and then the very bottom section is our cash position. Like I said, down here in column C is where you can list each of your bank accounts. If you've got multiple bank accounts that you access and use, put that information in there, and that's going to be adding up to your top cash position. Then you will, as you add dollars in and as dollars are taken away, it will give you what your estimated balance is going forward. So that's what the white row is here, is the estimated balance. And then you can go in and put in what your actual balances are in the gray area. So if you've got multiple bank accounts, you just put what those balances are at the end of each week, and it'll show you how good you're doing making these forecasts. So whatever you include will be totaled up, and you'll be able to compare it with what the spreadsheet is estimated based on your data. And if you're pretty far off, then you probably need to go back and examine what you're doing so that you can learn from that and improve, so your data just gets better and better. It definitely is a learning experience, and you'll get better at it the more you do it. So commit yourself to spending about an hour a week, keeping this up to date. And by the end of 4 weeks, you'll have it really tightened up. You probably won't spend that long going forward, but you'll have this tool that you can spend a little bit of time each week, but have great visibility for how things are going forward. All right, that's our spreadsheet. So I want to just finish up with our key points. So the primary reason businesses fail is they run out of cash. That's the main thing I want you to understand. It's not your profit and loss that you need to be paying attention to, although that's important. Your cash position is the most important thing. Your 13-week cash flow forecasting can help you prepare in advance for this for any kind of cash shortage. So you want to be able to look out 13 weeks and know how it's going. And then finally, when you have stable cash in your business, that means that you have stability in your personal finances. So we want to have those two things go together, because our business funds our personal life, and we want that to go in a real smooth fashion as well. Okay, so I promised you a few things. This is where you can go to download the cash flow spreadsheet that I just demonstrated, the owner pay calculator that I showed you in the beginning, and then I've got a guide for financial uncertainty for e-commerce sellers that's available to you as well. If you go to this website, you can download this information. If there's anything you have questions about or you need some additional help, feel free to contact me. This is my email address, and I'll be glad to answer your questions as best I can. Thanks for hanging with me on this, and I hope this has been helpful to you.